How to judge whether it's a good strong balance sheet or a weak balance sheet? So number one, as we discussed, look at the figure of reserves and surplus. More reserves and surplus, stronger the balance sheet. Number two, look at the debt equity ratio. Debt equity ratio. And how do we calculate the debt equity ratio? Debt of the company divided by equity of the company. That will give you your debt equity ratio. Let's say, for example, a company has a debt of 200, equity of 100, and this ratio is 2. So, more the debt, riskier is the company. And why riskier is the company? Because if you have more debt, you have to pay more interest. If you have to pay more interest, your EBITDA has to be that much more. You also have to repay the loan. That's why your EBITDA has to be much more. And that is how you look at the debt equity ratio. So when you look at the debt equity ratio, if a company's debt equity ratio is very high, that's a bad sign. If company's debt equity ratio is around 2, it's fair enough. If debt equity ratio is less than 2, it is good. It is good from the risk point of view, and it is also good from the point of view of a company's ability to finance the future growth plans by taking further debt. So that is how it is. Then you look at the current ratio. Third factor to judge the balance sheet is the current